Thanks for joining us on Squawk. I'm Bruce Whitfield. You're on CNBC Africa, first in business worldwide. We'll start off the show with the latest financial news and market story. And tonight, my little helpers, are Chris Gilmore from ABSA Investments, Happy Gilmore, and Mike Horwath from Applied Capital Insights. Nice to see you both on what's been, fortunately, a busier news week. My word, we've had to pull some teeth recently. JSE doing rather nicely again, back above the 40,000 mark as the S&P hits record levels. Bless you, Mike, as the S&P hits record levels and the Dow through 15,000.
Yeah, you know, we keep on talking about the Dow. I think we mentioned this the other day, in fact, Bruce, that the Americans are getting awfully euphoric about this, reaching these new highs. And yet, you go back 13 years, the year 2000, they were pretty much there. Yeah. So we've kind of gone through it.
Time value of money.
It's been destroyed at a rate of knots in real terms. It's actually been shocking. So I'd hate to have been an independent financial advisor in the US back in the noughties. Telling people that equity investments were the best thing since sliced bread because they just saw them going down in real terms.
But when we look at these levels of markets, nobody's believing these levels of markets, and you've got a lot of people like Chris Hart, who was here with us last week, saying that this is a piece of elastic that at some point is going to snap, Mike, that we are seeing markets being funded by the cheap money that is being flooded into markets from central banks around the world, and at some point it's going to stop. Maybe not next week or the week after, maybe not even next year, but at some point it will stop. Markets feel overinflated, are they?
We are in unusual times because from a monetary point of view, I mean, we haven't seen anything, I've never seen anything like this in my career. So, you know, when you talk about a piece of elastic snapping, well, you know, there's new players coming to the game and adding pieces of elastic at this point, being the ECB and now the JGB. Or the BOJ rather. Yeah,
the Japanese central bank, yes.
So the liquidity situation, and remember, of course, it's cumulative. And this is something I think people forget. On the margin, they keep adding every single month. And the Japanese have really upped the game big time. So from my perspective, until they start to see something in the underlying fundamentals, particularly related to employment and industrial production start to spark, this game's going to continue.
Good old-fashioned economic fundamentals need to come to the fore once again. You talk about the Bank of Japan, which has upped the game here. It's basically devalued the yen, and that's to try and make Japan more competitive. Is that what you're talking about? You talk about Japan opening?
According to them, that's a unintended consequence. But I mean, the idea is essentially that initially they have to get the yen to actually weaken in order to get the economic wheel to start to turn. And then hopefully with some structural reforms, which they're talking about, and with the fiscal stimulus that they're adding, which gives you the three arrows that Abe talks about, and then that should get the show rolling. Now they want to do this in 2 years.
Good luck to them.
You know, that's an enormous task. To get inflation up in 2 years, to get the monetary base expanded, doubled in 2 years, this is big stuff. It's big and bold, and we don't want to even think if it doesn't work.
No, that's the trouble. Let's talk about stuff closer to home. Let's talk about Venkat Srinivasan, or Srinivasan Venkatakrishnan. He likes to be called Venkat, so that some people who can't say Srinivasan Venkatakrishnan, we can pronounce his name better. New chief executive of AngloGold Ashanti. Could you think of a worse job in the mining sector at the moment?
Tough job. I mean, he's been there 9 years. He's well qualified for the position, I'm sure. But the point is, big shoes to fill in the sense of Mark Cutifani. But also, as you say, you're talking about a horrible industry at this point in time, where in many instances, in many of the mines that they got, they're operating below the kind of the marginal cost of production. You know, so it's terribly tough. And many investors out there, including ourselves, and we've taken the view that we'd rather, if you want a small exposure to gold, rather go into the metal directly and get away from all of the problems that are facing the gold mines. Right, I
mean, these are the companies that have added zero value over the last 10 years, Mike. If you look at a heat map of performance over the last 10 years, the deep dark green is Pinnacle Technology, Capitec and PSG. Big bright red to match your tie is the gold sector uniformly. And AngloGold is tragically amongst those, despite the fact that it's been well managed through the down cycle of gold.
Well, inevitably, if you're getting deeper and deeper, you've got to put in big investment to keep that game going, and you need real technical skills to be able to keep that going too. Now, I think in both cases that has slowed down dramatically. So we've seen negative production volume growth in the gold industry of 6 and 7% for years now. how you actually revive this thing, other than you do an ergo kind of trick. You know, I'm not sure, because it is, you know, the labour has become unmanageable. So you say to yourself as a management team, I can't control the gold price, I can't control the rand, I now can't control my labour force.
Although Neil Frenneman, bless him, yesterday, in his wisdom, says, I've got a really good idea on this whole labour thing. Mine workers don't have an appetite to strike at the moment. I don't think they'll push for double-digit increases, which then simply is red rag to the Num Bull. And Lesibo Sishoka says, okay, bring it on, big guy. You want to have that fight? We've got problems of our own. We're arguing with AMCU. We're fighting for the relevance of Num. We've got a point to prove as well. We're heading for argy-bargy in the mining sector.
Yeah, when I saw that, I mean, you took the words right out of my mouth. Red rag to a bull is what sprung up there. But it's fascinating now. If you look at what's happened in industrial action and mining action for the past 6 months, probably ever since Marikana, the conventional wisdom in recent times has said that there's a thing called the power of the debit order. In other words, people are scared to go and strike. They don't have the appetite to strike. And yet, you look at the lengthy strikes we've had. We've had some really long and very, very damaging strikes. At the end of the day, in many instances, the workers have had what I'd call a Pyrrhic victory, in the sense that they win that, they get a nice fat wage increase, only to see a massive destruction of jobs taking place a few months later.
Is the power of the debit order behind African Bank's real woes here? Because African Bank, it was after we last spoke, it was Friday, comes out, it was actually late in the afternoon on Thursday. Friday saw a 17% decline in the African Bank share price. That continued on Monday and Tuesday. Yesterday they bring out a statement saying, look, we need to clarify, it's bad, but not as bad as you think it is, and the share price recovered a little bit. But African Bank is being badly bludgeoned by Elleren's 6 years into buying it.
Yeah. With hindsight, I wonder if they would have done the same thing. I mean, I think they've done a great job with Elleren's, make no mistake. But now you're in a situation at this point in the economic cycle, we've debated it before, where Elleren's, JD and Lewis are now languishing and likely to do so for quite some time to come. So no matter how good and lean the company is, the problem is you're now at the mercy of the economic cycle. But over and above that, you know, I was quite surprised at the length and the severity of the slump in the share price. And thank goodness Mr. Kirkinnis came out and said, well, you know, things aren't really quite as bad as they are.
Yeah, but then you should have communicated that in the first place.
In the first place, you know.
Yes.
I mean, there were a lot of jokes going around. People were saying, well, you know, it was the earnings decline that was 28%, not the share price that we're talking about.
They virtually matched each other.
Yeah, but it's bounced back quite nicely.
Oh, yeah.
Yeah.
But it has. But it also underpins, perhaps, Mike, our uncertainty about and our trust in the ability of the microlenders to keep extending the loans, keep running the books, keep the growth figures going, which are necessary to sustain the sort of multiples these things are trading on.
But Bruce, I mean, you just saw with our recent labour figures, employment figures, the employment growth's just not there.
Well, we've lost 100,000 jobs in the last numbers, 25.2% of people are unemployed, and a bunch more, of course, have given up looking for jobs. These are people who, just like it's not worth the taxi fare to go and stand on the side of the road to look for a job anymore.
So the public sector is finally slowing down in terms of its hiring, and of course that's been a very strong underpin for the unsecured lenders. And we've got inflation rising, so your discretionary income, certainly at the lower end of the income market, is getting really hurt. So if you look at retailers, broadly speaking, the upper end retailers are still pretty resilient. The bottom end guys are getting hurt quite badly. And inevitably that's going to impact. We started to see from the DI 900s back late last year that your credit loss ratio is starting to rise. So there was no surprise in that. And that cycle, it takes a good 9 months for that to feed through the system. So there's no question that this year is going to be a tough year in that respect, and it'll probably only peak sometime in the second half.
Then you've got to question the wisdom of bringing Burger King to South Africa, because here we've got a massively competitive fast food, QSR, if you like, quick service restaurant market, and Hassad Adams is bringing Burger King in. Today's day one in Cape Town at Herengracht. They're flipping the first Burger King burgers, delightful burgers. Is it going to fly?
I don't know, and this is the $64,000 question, or maybe even a bigger figure. You know, if you look at McDonald's is a class operation. It's been here for close on 20 years now.
It's only really just beginning to do anything
exactly.
now.
And because they've changed the format, I mean, as I say, they're a class operation. They really know what they're doing. But they've got some very stiff competition in the local guys.
Famous Brands has bought anything that wasn't nailed down.
Well, there's that, but you've also got KFC. You
Yeah.
know, KFC is the biggest single brand in the country with what, I think about 700 outlets around the country.
Yeah.
So huge local competition here. Burger King has really got its work cut out. I don't think it has the same degree of recognition in South Africa as McDonald's and
Hollywood
KFC.
has done half of McDonald's job for it in South Africa, and even with that support of Hollywood, it didn't fly for a very, very long time.
Yeah.
Hassan Adams maintains that every single shopping centre in South Africa wants a Burger King inside. But unless you've grown up in a culture where Burger King is prevalent, and you watched what was the movie?
American Graffiti?
No,
no,
different
before
movie. No, different movie. John Travolta, Samuel L. Jackson.
Pulp Fiction.
Pulp Fiction, thank you very much. That's the only reference many South Africans have had to Burger King, because they produce the Whopper. Is Burger King going to fly in South Africa, Mike?
To me, it looks like a Me Too.
You haven't tasted it, have you?
No, I haven't. But
I feel quite weak.
there's no question that convenience food industry is absolutely flying in this country, and it's a secular trend. Born and driven by urbanisation and the continued decentralisation of retail. So to that extent, there is room. Whether they can actually really climb in and take big market share from the big guys, I'll question that. So if you ask me where would I like to position myself, I think I'll stick with my Famous Brands, and I would like to go and find out who's supplying all the bread rolls and that kind of thing.
Absolutely. I mean, you look at Famous Brands and you look at the huge growth that we've seen in the Famous Brand share price, trading around 85, 87, around 50, thereabouts, record territory once again. I mean, they have bought up the, lunch in a Europa the other day and said, hold on a second, I might as well be in Wimpy. Because they have been in a not that competitive market, massively acquisitive, and been very, very clever with it. Take me through your thoughts, please, on the possibility of an interest rate cut. Now, I know we touched on this last week, but then the Australians on Monday, Mike, decided to cut interest rates. And again, we're hearing all the stories that the South African Reserve Bank is going to have to follow suit, despite the fact we've got an inflation problem. What's your thought?
I think the probability is growing, simply because I think the Japanese situation is so big. And inevitably it's going to come in waves. So the timing of it's very difficult to predict. My sense is that the first thing is you flatten the yield curve, so you now start to put some pressure on those real yields for the big institutional investors in Japan. You then manage to get your inflation back up to zero at the very least, and now you've got no real returns. But you've still got yield targets on your liabilities in the big insurers, so they're going to have to move out of the country and look for it. So they'll probably go to all the brokers and these big funds in the UK, and we'll start to see the funds come into our kind of markets, the high-yielding markets. Yeah. So my sense is that we are going to have more capital inflows coming in, despite our deteriorating fundamentals. And I think it's going to put real pressure put it this way, the SARB can't raise interest rates in this environment. It'll just actually exacerbate the situation. So the chances are that they might well have to lower it. And presumably, ultimately, that's the end game, that the advanced economy central banks, with all of these zero interest rates and now flattening all the yield curves, the long-term outcome of all of this is that most of the emerging market yield curves are going to get maybe not completely flattened, obviously, but certainly lower. And this would explain why some of the property sectors are doing so well, both domestically and internationally. They've got great support.
It's on the assumption that rates are inevitably